Welcome back. In today's episode of EnfTrader, we're going to explore the concept of breaker blocks and how this can give you an edge in the market. Understanding this technique will help you identify high-probability trading setups on the price chart and ensure you don't miss out on optimal trading opportunities. In this video, key criteria and guidelines for spotting high-quality breaker blocks and effective trading setups will be discussed. If this sounds interesting, please support the channel by liking this video and subscribing if you're new. Let's dive in. Let's start by understanding what an order block is. An order block is a key area on the chart where significant amounts of capital have entered the market, typically by big banks or large institutions commonly referred to as smart money. These entities execute substantial buy or sell orders that cause noticeable price movements. Order blocks form when there is a significant imbalance between buyers and sellers, marking areas of supply and demand. In a bullish scenario, the last bearish candlestick before a drastic bullish move is identified as the order block zone. Alternatively, the first weak bullish candlestick before the bullish move can also be recognized as an order block. The same principles apply in bearish scenarios. So if you notice the price moving sharply from a specific area like this one, it could indicate that smart money has taken a position. Large buy orders are needed to drive the price up this quickly. The initial area where these trades are executed is known as an order block. Once identified, order blocks provide potential trading opportunities as the price often retests and reacts upon reaching these zones, resulting in a significant price reaction. When discussing order blocks, we focus on the last candle that created an inefficiency, which we refer to as the order block zone. This zone is believed to be where key decisions are made. Order blocks can appear either at the beginning of a strong price movement or within the movement itself, often represented by candles that are either similar in color or contrasting. To identify a valid order block, there are three essential criteria. The first is break of structure or change of character. A break in the market structure or a change in character signals the market's intention, indicating whether it will continue in its current direction or reverse. Number 2 is creation of inefficiency. An inefficiency arises from significant price movements that create gaps between the shadows of candles. This can be illustrated by comparing efficient and inefficient price actions. And number 3 is unmitigated order blocks. Order blocks are considered one-time use, meaning we only seek trading opportunities when the price first interacts with an order block. Alright, now that we've examined the concept of the order block together, let's move on to learning about the breaker block. To start, what exactly is a breaker block? A breaker block refers to an order block that has previously failed and has now transformed into a significant supply or demand zone on the price chart. This transformation typically occurs when an earlier order block is breached in the opposite direction, switching its role from supply to demand or vice versa. Essentially, a breaker block serves to mitigate positions, acting as a region where new positions can be added. Whenever the price breaks through a major demand or supply zone without respecting it, that zone changes its role. A supply zone can turn into a demand zone, and vice versa. The same principle applies to order blocks. The market might overlook the supply and demand of an order block due to various reasons, such as changes in market structure, being overbought or oversold, tapping into significant areas on higher timeframes, or reacting to important economic news and other fundamental factors. When a valid demand order block fails to hold, and the price breaks through it downwards, it becomes a supply level, which we refer to as a breaker block. In this case, the expectation is that the price will reject this area and continue to move lower. To effectively identify valid breaker blocks and leverage them, several criteria and rules must be taken into account. The first criterion involves clearing buy-side or sell-side liquidity. When identifying valid breaker blocks, the price should clear an area of liquidity before a market structure shift occurs. Here's a helpful tip. When identifying a valid order block, the price must break and close above or below the recent swing high or low to establish a valid break of structure alongside the order block. However, this specific requirement is not mandatory for a breaker block, as there's no need for the price to close with a candle body above or below the recent swing low. The second rule states that in a bullish scenario, the price must exhibit a sharp movement that creates a higher high, while in a bearish scenario, it must form a lower low. This ensures that the price moves significantly higher or lower over multiple candles, filtering out single candle spikes or drops that could mislead traders. The third rule asserts that a breaker block is only deemed valid if the price breaks and closes above or below it with the body of the candle. Mere penetration with a shadow or wick does not qualify. Lastly, rule number 4 states that breaker blocks are considered for one-time use. This means that the focus should be on the trading opportunity when the price first enters a breaker block. Once a breaker block has been mitigated, it should not be regarded as a significant area for future trading. To integrate all the criteria and rules for identifying valid breaker blocks, let's take a look at a real chart example. Now, let's analyze the Eurodollar on the 15-minute chart. Initially, we observe a swing low followed by a swing high, and then a strong downward movement that breaks and closes below the previous swing low. This action creates a valid order block, indicating robust supply for short positions. Once the sell-side liquidity is cleared, the market suddenly shifts direction after confirming a new lower low, moving upward. Eventually, the price breaks and closes up the high of the last bullish candle, marking a significant change in market structure. This area now qualifies as a valid bullish breaker block, signaling that sellers in this zone have been stopped out. With the bullish market structure shift, this area of supply has turned into a demand zone, leading us to anticipate price rejection from this breaker block and a continuation of the upward movement. As observed, the price initially moves downward and pauses momentarily within the breaker area. After accumulating more sell orders, it gains momentum and pushes upward. The first high-quality type of breaker block that offers a strong probability of success occurs immediately after a liquidity sweep pattern in the market. As discussed earlier, a liquidity sweep pattern is defined by a single candle that clears liquidity above or below the previous high or low. This pattern typically precedes a swift and significant market reversal. Following a liquidity sweep, we expect the price to quickly return to the range of the most recent swing low or swing high. A liquidity sweep can be identified by a candle with a long wick or body, followed by a sharp price movement that results in a market structure shift. Upon closer inspection, we can see that the price has formed a valid unmitigated breaker block at the location of the last buying candle, which was created just before a sharp downward movement. This breaker block meets all the criteria for an ideal setup. The price has cleared sell-side liquidity and, after establishing a new lower low, has reversed direction, creating a market structure shift by breaking and closing above it. Here, we have identified a valid breaker block positioned. Therefore, the entry should be set at the highest point of the breaker block, with a stop loss placed a few pips below this. The second high-quality setup occurs when a breaker block aligns with a significant liquidity void in the market. This typically happens when the price breaks the breaker block inefficiently, leaving a gap in the market. This scenario presents an excellent opportunity for executing buy or sell positions with a high probability of success. Another high probability setup arises when a breaker block is paired with an order block. In this situation, an order block forms near the breaker block area. These breaker blocks are particularly powerful because the price is likely to respect them, representing areas where numerous orders were previously executed. There may still be orders held in that area, increasing the likelihood that the price will return to retest it. In this scenario, we have identified a valid breaker block paired with an order block. The entry should be set at the highest point of the breaker block, and traders should patiently wait for the price to trigger the execution of the trade. That's it for today, traders. Thanks for watching. Please support the channel by liking and subscribing. Any questions can be asked in the comments, and the team will do its best to respond.